A little better.
Hello, everybody. 5 minutes late. JSG had some technical difficulties. So, Dana and I are not the most computer savvy in the world.
Not at all.
May come as a shock to you, but we're here. So we're making the effort. Representing the Gorcat, the Wildcats.
Word.
Hi, Angie. Sorry we're late. Hi, everybody. Sorry. We bring shame to our family.
Sorry.
You too. What up, guys? We've got our kiddos here too, so.
That's right.
What's up, Al?
We got the crew.
All right, well, good. Looks like everybody was here.
Hanging out,
good.
waiting.
Yeah. While we're killing a couple seconds here, since, we have these fantastic, buying a home. Everything you need to know. Really cool packet. Got all our stuff in it. This is the, if you're interested in buying or selling a home, we have a nice little packet that we can send out to you electronically or via mail.
Lots of good info.
What's up, Shannon? So our topic today for episode 9 is everything you need to know about buying an investment property. So real estate, as most of you know, can be a very good investment, and the return, there's the secret sauce, I think, about investing in real estate is tangible. So if you buy stocks and the company goes out of business, you have no control over what the guy running the company's doing, and it's a whole thing. Real estate is real. You can look at it, you can touch it, you can feel it. You can go and knock on the door, make sure that guy's paying your rent, and of course there's some tax advantages. So we'll talk about some of that. So Dana has a rental property that's been very good to him. What's your positive cash flow on that puppy?
Mean a year?
Month.
A month? $500.
Yeah. So
clear.
Yep. So, and then he's going to have it paid off in what, 10 years?
Yeah.
So in 10 years, his house will be paid off, and he's been getting $500 a month positive cash flow on top of getting it paid off. So
2003.
Yep. So, and really, you've been fortunate.
Yes.
It's been a pretty smooth ride for him, and there's obviously some tribulations with that. So let's talk, first of all, there really are 2 categories of real estate investment, at least for our purposes today. It's flips and buy and hold. And everybody has heard the commercials, how easy it is to buy real estate with somebody else's money. We had one of our other agents on the team today came in and had some guy that sent in this list, and it was obvious he had just watched a webinar somewhere.
Or went to one of the classes.
Right, and finding a way to get owners to hold notes. And it's there's moments for all of that, but it's pretty rare. So for the most part, when you flip a house, and this is what Dana did for years, you either have cash or you use what's called hard money, which is very expensive money, but it's sort of readily available, and there's not a lot of strings attached to it. You have to put up the equity in the property, and basically what those lenders look for is sort of a safety net in terms of loan to value. That's LTV, as they call it. So, and then the other side of it, which would apply, I think, for most people, if you're just all of our friends, really, and you just say, hey, and a lot of people, you sort of default, like Dana sort of defaulted into being a landlord. He had his house, and he lived in it, and then decided, hey, you know what, I'm going to move, and I like the house, and so I'll keep it. And other times, you have bought a house, and maybe you bought it at the wrong time, and the values aren't there. So you end up in a situation where you almost have to rent it. And then when the market turns, then all of a sudden it becomes a good thing. So for those people, if you own a house already, the one thing I would point out is the type of loan you have on that property is going to dictate your ability to buy another property. So if you have an FHA or a VA loan, you're not going to be able to reuse that product on a second house. So you might think ahead, refinance that property first.
Into a conventional.
Right, into a conventional loan. And then move forward that way if you still need to use an FHA or a VA loan. Something to keep in mind. And if you go from scratch, if you're saying, hey, life's turning around for me, I'm doing well, I want to go ahead and buy an investment property, what might that look like, Dana?
As far as what?
In terms of financing.
Well, I mean, you could do, conventional, or you could do hard money. I mean, again, depending on if you want to buy an investment property or whether or not you want to buy a property for flipping.
Yep. And the big thing there is the rules are a little different. For conventional loans, and most of the time, if you're doing an investment property other than like multifamily, but we're not even going to get into all that, but you're going to do a conventional loan, and you need, and I see Kindle's on, help me if I'm wrong, I think it's at least 10% down, right? For an investor property, and your interest rate's going to be somewhere, depending on your credit, half a point, maybe a point higher, Dana?
Yep.
And then you're going to need some reserves. So with your primary residence, they got 25%. So you got to have a little bit of cash in the game, and they see reserves, 6 months on reserves, Kindle. Basically, they want to make sure you have enough money to make the mortgage payment if your tenant doesn't pay. Hi, Mama. So it's a buffer. So and then one of the things you want to keep in mind when you're looking at investment property is what return on investment you should expect. So the general rule of thumb that we preach anyway is you want a 10% gross return on your investment, which means that if you are buying a house for $240,000, Dana?
Yep, it should bring you $24,000 in gross return
a year.
A year.
So which translates, figure $2,000 a month.
Right.
So that's where you talk to your good old friends, your good realtors at the JSG, and we'll run those numbers for you and find out what you can reasonably expect. And of course, you're going to want to think about when you buy that property, that rental property, what your extenuating expenses are going to be. Mm-hmm. So if it's a house that you get that has a new roof or windows that are going to be down the line in a few years, you're going to need to make sure that you factor in that. And so one of the things that I think we've always preached too is if you are in a positive cash flow situation, do something constructive with that money. Either pay down the mortgage or set the money aside, because things are going to happen that are going to cost you money down the line. And
for years, Mindy and I, we have a completely separate account for the houses in Hartford County, and now the new house in Poplar is completely separate. We don't mix it with anything else. It's its own little kitty, because we know roofs are going to be coming along, or there's going to be a month where it's not rented, or water heater, or God knows what, or somebody comes in and they, unfortunately trash the house, or they just don't take care of it as you would, and you're going to need to put carpet in and paint in, and what else comes up.
Yep. Something else you want to think about is the type of property you buy. If you buy a single family house, generally speaking, there's not a whole lot of issues with that. But if you get into condos, you end up in a situation where there are guidelines for the percentage of properties that can be rented, and you need to be careful. If you cross that threshold, it can sort of cause trouble for the whole community, not just you, but long term. So if it's a community that's sort of trending into rentaldom, if you will, and they cross over that it becomes difficult to get a loan in the neighborhood, and then you could end up in a situation where maybe you didn't make the wisest investment. Because what you want, the great thing about real estate is, along with the cash flow that you get, there should also be appreciation. And for the last 60 years, houses have appreciated an average of 7% a year. So obviously, anybody that's been alive for the last 10 years in real estate knows that there's been some turbulence in that. But good, bad, or indifferent, for the last 60 years, if you average it all out, you got 7% a year. So on top of the cash flow that you generate and paying off the mortgage and owning an asset, you're also appreciating right by 7% a year. So something else that we have a client right now that is working on that's a little more intricate, but 1031 exchanges. And hang on one second. You need to back off. We got our kids with us today. We love our kids.
We do.
But, we got Waldorf and what was the two guys from the Muppets up in the balcony heckling us right now. So 1031 exchanges. So there's a couple of things you can do. And we had this discussion in the office today with one of our other agents. You can be really creative, and you can, if you do some long-term planning, and we love to talk about the chess game here in real estate. So, but in general terms, a 1031 Starker like-kind exchange is a product that is, I guess it's a IRS product that allows you to defer, not escape or avoid, but defer taxes from one property. So let's say Dana's
capital gains.
Yep,
tax.
we're going to use Dana's property as an example in Harford County. So he's obviously been paying down. He's going to make a nice profit on it. So let's just, for easy numbers, he's got $100,000 in profit there, and he would owe long-term capital gains, which is between federal and state 22.5%. So he is, or 22%, I guess. So he wants to buy a rental property in Florida. So he has to put the same amount of money that he makes into an escrow agent will hold that money. And he has 6 months to identify, and he can pick a certain number of properties. These 3 properties, he can identify the properties, and he's got 60 days to once he has settled on his other property. So he's got this time frame, but then he can take that equity, put it into the new property in Florida, and defer the taxes that he would have owed. So, and then
that property has to be, correct me if I'm wrong, equal or greater value
correct.
than your current property.
Absolutely. Yep, that's a big nugget there. So it's a little bit of a nuanced product, but it's a fantastic way to do some long-term planning and not pay those capital gains at the time. And then if you really play the game on the long side, you could buy that property in Florida, rent it for 3 or 4 years, and if you say, look, I know in 5 years I want to go and move to Florida, go down to Florida, move into that rental property, and as long as you've rented it for a long enough time that your accountant, and again, as we like to say here, seek competent legal and tax advice. But if your accountant is on board that you rented it for the requisite amount of time and you move into it, it can become your primary residence, and
then, of course, then you sell your current residence,
right,
and then you don't have capital gains on that one,
right,
either.
So it's a very cool and interesting product, and there's other things. There's loans specific to that, and then there's LLC benefits to owning rental properties and property management things. So we here at the JSG have worked with investors for years, and we know lots of good information and nuggets on said topic. So again, our most familiar refrain probably on this show is just make sure that you find somebody competent. And again, this falls into that tricky category where you can get an agent to work for free and you go, oh, well, any of them will do, it'll be fine. And where it's really not true ever, it's especially not true when you start stepping in these landmines, because the one thing you don't want to do is buy a property and end up in a negative cash flow situation right away.
And then, like you were saying, if it happens to be one of those properties to where you step over that threshold with the renters, and then you decide that you want to get out of that property, you may not be able to get out of that property because you can't get an FHA loan there or VA loan. You can't sell the house.
Right.
So,
and I will say, I think next week we are going to talk a little more flipping. And I might not even show up for that one. I'll let Dana could run that show for sure. But we're going to talk about flipping. And again, we hear every day from people who are eager to drain their 401ks and get into the real estate investment world. And it's fraught with danger to begin with, but there's certainly things you need to know about going into that process. So I believe we've used up a fair amount of time here on acquiring a proper long-term rental property, and so next week we'll touch on that. But again, I thought we might cover both, but that's not going to make it today. So anyway, kids,
Brody, Brielle, Jack, say hello to everyone.
Say hi to the guys that keep us working so hard.
Hello.
One more. Where are you?
Hi.
Here you are.
So that's Jack, Brody, and Brielle. So quite proud of all these. We got a bunch of A students here.
Yeah.
And They are they're budding hecklers. They're going to be fantastic.
Yes, they are hecklers. That's for sure.
So, all right, guys.
All right.
Kendall's saying something here. Can pull cash out of their primary residence, have down payment. Yep. So that is one of those. Just if you talk to us, we're experts at finding things and finding ways to do things that other people can't. So, yeah. All right, friends. It was good seeing you tonight. Sorry for the delay. Hope it was worth the wait, and we look forward to seeing you next week.
Gork, sponsor
See you, everyone.
us.
Have a good one.
Sponsor us, please. Gork.